Good morning, viewers. It's Friday morning, April 25, 2025, and I'm your host, Sunil Thakker of Sunny Talks Money. Welcome to ST Money's 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. The relief rally is barreling forward. A tech rally powered stocks sharply higher for a third straight session on Thursday, led by the Nasdaq Composite, which was up 2.74% to 17,166. The Dow Jones Industrial Average added 1.2% or 487 points to 40,093, and the S&P 500 gained 109 points or 2.03% to 5,485. Investors parsed a mixed bag of corporate earnings and watched for signs of progress in the US China tariff standoff as the markets received a solid boost from technology shares. Apart from the tech boost, Wall Street investors weighed the impacts of Donald Trump's trade war on corporate America and sent stocks climbing amid reports that the president said the US is talking with China on trade despite Beijing's denial. President Trump said Wednesday his team was actively talking to Beijing about trade after it was reported the US was considering slashing its China tariffs. Beijing played down hopes on Thursday for an imminent rapprochement, saying it hasn't held negotiations with the US, let alone reached an agreement. Rather, Beijing called for cancellation of US tariffs on Chinese goods following comments from US Treasury Secretary Scott Bessent, signaling the White House could be willing to de escalate trade tensions that have whipsawed markets for weeks. Easing tariff rhetoric is part of the reason why chips are leading, because they have been kind of in the bullseye in the trade dispute between China and the US. So, any cooling of tariff talks between the two countries bolsters the technology sector as a whole. Momentum began with hope earlier this week that Trump administration is softening its stance on China and the Federal Reserve. Meanwhile, investors are watching earnings for clues on how the economy and the market turmoil is affecting companies and consumers. On the economic front, new data showed sales of existing homes fell 5.9% in March, the biggest monthly drop since 2022, after economic uncertainty and higher home prices deterred buyers. On the data front, stronger than expected new orders for durable goods and range bound jobless claims painted a picture of economic resilience. Investors expect volatility is here to stay as the White House continues to flip flop on trade and economic policies. As first quarter earnings season hits full stride, the extent of which trade war uncertainties have affected business and consumer sentiment is making itself known. Of the 11 major sectors of the S&P 500, all but consumer staples advanced, with technology shares enjoying the largest percentage gains, up 3.5%. And of the 157 companies in the S&P 500 that have reported so far, 74% have beaten expectations. However, Procter & Gamble, PepsiCo, Chipotle Mexican Grill, Merck, and American Airlines all cut or withdrew forecasts due to elevated uncertainty among consumers. They warned that tariffs are likely to drive up costs. American Airlines Group Incorporated withdrew its full year earnings outlook, joining a growing number of companies hedging their bets on the broader economy. Southwest Airline Company's chief said his industry is already in a recession. Shares for Procter & Gamble slid by 3.7% and PepsiCo tumbled 4.9%. Not all guidance was downbeat, though. The Magnificent Seven group of artificial intelligence related mega caps was boosted by AI powered software firm ServiceNow's better than expected quarterly results. ServiceNow's profit was better than analysts expected due to resilient demand for AI powered software. Its shares jumped 15.5%. Hasbro's results beat expectations, helped by the strength of its gaming segment, sending the toy maker shares up 14.6%. Alphabet and Intel were among the largest companies to release earnings after the bell. The Google parent shares rose 4% post market, while Intel fell 5%. IBM shares weighed on the Dow, dropping 6.6% after earnings. In recent tradings, the benchmark 10-year Treasury yield fell to 4.304%, having settled Wednesday above 4.38%. The WSJ dollar index weakened as the greenback fell against the euro and Japanese yen. Gold futures rose to $3,332 a troy ounce. They had hit a record high on Tuesday before sliding on Wednesday. My take: capital flight from equities, not treasuries, could hurt America. Though investors have been most concerned about treasuries, equities look far more exposed to an exodus of foreign investors. Concerns about capital flight have focused on the government's debt, but the implications for stocks and the US dollar could be more serious. It is the stock market that has arguably grown more dependent on foreign money. Since December 2011, overseas holdings of US equities have grown from $3.8 trillion to $18.6 trillion. The percentage of treasuries held abroad in the same period has meanwhile fallen. Moreover, foreigners often sell treasuries during periods when they perform well and buy on dips. This is because bonds aren't typically bought to generate huge returns, but to serve as a portfolio ballast, for example, in the 60-40 strategies or as liquid reserves. Fixed income owners are a lot less price sensitive. For example, central banks just want to hold dollars and put them somewhere safe. That's not the case with equities. That's why they are considered risk assets. Equities respond a lot more to sentiment, which is reflected a lot more in flow. Foreigners' money flows in and money flows out of equities just as a fair weather friend. And that's why I say, despite the apparent tariff U turn, contrary to popular belief, drawn out capital flight from equities and not treasuries could still hit US markets. And that's a wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. You can contact me at st@st-money.com for any further information. I'll see you now again on Monday morning. Have a great weekend. In the meantime, happy investing, stay inspired, and remember, it's all about money.